It's Warren Ingram from Galileo Capital, where he is an executive director. He also spends time advising people directly. He is a personal financial advisor. Before we talk about the big topic, which is shares and buying shares, no matter what the price is, Warren, a question from Roberto saying, I own shares in the USA via, this is important, I think, the Easy Equities app. When I sell these shares, I assume there is capital gains tax. Do I need to submit a tax return in the USA for those capital gains, or is it calculated automatically?
It's a lovely question, Roberto Center. So I think always with tax, take what Warren says advisedly, because I'm by no means a tax guru. But my understanding, Bruce, is that because we have double taxation agreements with the US, that means that if we're liable for taxes on a tax in South Africa and in America, but the taxes in South Africa are higher, then firstly, we don't need to pay the taxes in America. And then secondly, in this instance, because it's running through Easy Equities, the capital gains tax, in my view, will be paid in South Africa to SARS and then not to the US. So I don't think Roberto has to register for tax in America at all. But just kind of two main comments. One, you just know that when your investment gets over $60,000 in size, and you've got American listed investments, in other words, a share in America or an exchange traded fund, and you pass away, then you are liable for estate duty in America, and no matter the fact that you're a South African. So that's the one that concerns me more. But capital gains tax, I don't think so. And then just remember, you can make 40,000 rands worth of profit every year before you start paying capital gains tax.
Okay, and it also depends on where the money is domiciled. If you take money, rands, and you buy dollars, and you go and buy directly on the New York Stock Exchange, that money and those shares are domiciled in the United States. Therefore, the tax surely liability would be there. If you're buying via a South African platform, I can't see why you would have to pay tax elsewhere.
So it's so because we are a residence-based tax system, the starting point is that where we live is the most important thing. But
okay.
When you get to especially things like death duties, more so than capital gains tax, Bruce, then it's actually where the actual investment itself is listed. So using your example, where you're buying it through a South African nominee company, but actually the share is listed on the New York Stock Exchange or the NASDAQ, then there's every chance that you're liable for death duties in America.
Okay, all right. No, I think I've got you on that one, Warren. Thank you for that one. Okay, can you just ignore the price and buy shares? Sounds like a mad idea, but I'm curious to hear the arguments.
So I think it's probably two parts to the answer. I can never just give you one straight yes or no. That would be very boring. And so I think the starting point is we obsess, all of us. It doesn't matter who we are, and unless we're robots or psychopaths, we spend far too much time worrying about prices of our investments, about getting in. When do we get in? The prices are rising too fast. Shouldn't we get out? And that applies to shares. And if you look at exchange rates, the same thing. We spend so much time and energy on prices, and what we know is that all that energy and effort that we put into trying to understand when we should buy, when we should sell, and predicting or forecasting to give it a more kind of a nicer color of paint. You get to the point where you realize you actually can't do it, and all that's going to happen is you're always going to be perfectly wrong. You might be sometimes reasonably right, but you're always going to be, you're never going to hit it correctly. And the problem with the argument around shares then in particular is, we need to understand, how do we get real growth from shares over long periods of time? And real growth is industry jargon. What it means is, how much growth do you get above inflation? And that's really, for me, why we invest our money, is we want to get proper capital growth over long periods of time that protect us against inflation, so that our money is growing faster than the cost of living is growing. And in that instance, it's important to understand that one of the big keys to getting that real growth is earning dividends from shares and getting those dividends reinvested, year after year after year, and allowing those dividends to grow as well. And I think that, if we're sitting there worrying about the price, what we're doing is in the interim, we're sitting on cash. Cash doesn't pay dividends. Cash doesn't grow at a rate faster than inflation. So now we're missing out on one of the cornerstones of getting stock market growth is, we're just not there. We're not getting the dividends. We're waiting for the price. And that can be really painful. So there's an awesome study done by Yale University. And what they looked at was, how much of this growth that you get from the real growth that you get from shares over long periods of time, how much of it comes from earning dividends and then importantly reinvesting those dividends. And it's going to be somewhere in the region of half of your return will come from reinvesting dividends if you're investing for periods, let's say 20 years. And it goes up to 80% of your growth if you're investing for longer periods. And longer periods, for example, 40 years might sound ridiculous. But actually, when we start out our investment career, most of us probably do it around about the age of 25, and we do it with small amounts of money. But actually, most of us will invest for at least 40 years. So 40 years is a really relevant period. And if you're spending all of that time, sitting on the sidelines, hesitating, not committing money to shares, then what happens is you're missing out on the real engine of growth. You're actually, you've got this wonderful car and you've taken the engine out and you left it outside and it's busy getting rusted and falling away. So my view is if you can't make this call on when to invest, then the answer is ignore the price. Don't make that decision. Take it out of your whole framework and just ignore it altogether. In other words, if you've got a lump sum of money and you're fortunate to have earned, some kind of a bonus or you've got a cash amount to invest, then, take 6 months and take that amount of money, divide it into 6 and invest it in the stock market in 6 equal amounts over that 6-month period. And don't worry about what the price is doing. Pick a day. Say it's the first Monday of every month. I'm just going to buy and I'm going to close my eyes. And if you're doing a debit order, then please don't worry about the price. In fact, just, don't look at anything got to do with the price of your investments because over short periods of time, they're completely irrelevant. All they're going to do is give you a stomach ulcer and maybe force you to make the wrong decision because you decide not to invest while you wait for things to happen. Whatever those things are, you're not going to get them right. You're not going to predict them. And you're losing out on those dividends that are growing and growing and growing on themselves.
Somebody with far more experience than you and I, somebody who's been in investment markets for 9.5 decades probably, is Warren Buffett. Price is what you pay, value is what you get. And Warren Buffett's very determined to pay the cheapest possible price he can and to hold for the longest period he can because that gives you the very best return. And in particular with large capital amounts, I would argue that you're looking for value the whole time and you want to get the shares at the best price. But when it comes down to the habit of investing, I couldn't agree with you more. And that is, it doesn't matter what the price is. Just make sure that you're buying something each and every single month. Don't second guess the price because then you sit on the sidelines. And then as prices start going down, you don't buy either because you're not in the habit of buying. And therefore, you lose out on the opportunities of pullbacks and corrections in markets too.
Absolutely, and if we look at Warren Buffett, as a great example, when he looks at that price versus value conversation, he's usually buying almost an entire business, or he's buying something that maybe the rest of us wouldn't necessarily look at, and he's done a calculation, or nowadays I guess his team has done a calculation to determine what that value is. But firstly, Warren's a really smart guy, and secondly, kind of a unique talent, I guess, in the world of investments. For the rest of us, we probably don't have that ability. We don't have a team like he has. He can call on Charlie Munger, who I think is one of the great brains of all time, to kind of help him think things through. If it's just me and my 2 dogs, I don't have that ability. And so for me, I'm not going to worry too much about the price, even if markets are expensive. And I think it's so irrelevant now. When we're looking at the US, and people are saying, "Gee, the tech market is so expensive," and the American stock market's been running. It has. I'm not discounting that. But what I don't know, and no one knows, is it could carry on running for 3 years. It could fall over tomorrow. But what I do know is if I have a lump sum and I feed it in over time, the impact of that fall might be mitigated. And whenever you do phasing in over a longish period of time, like 6 months or 12 months, the chances that you have a permanent loss of capital is very small when you're buying, the broader stock market. Of course, you could buy one share and be horribly wrong. And then, you focus like Warren Buffett does, if that's what you want to do. But if you're doing a lot of investments in shares, lots of diversification, truthfully, I think you can ignore the price and you will be better off in 99 out of every 100 times. And you'll certainly be better off than the people that are sitting on the sidelines, with their money in the bank going, well, I'll wait for everything to get better, because, the bell doesn't ring to tell you that everything's better and now's the time to buy.
Most certainly not. Warren Ingram from Galileo Capital, financial advisor. He helps us on a Thursday night understand money and markets. From Jen this evening, a question, Warren. I will fortunately be receiving a 13th check in December. What's a 13th check? They're only 12 months. You get an extra check. That's amazing. I am at an age where I cannot afford to make poor financial decisions. Do you have any tips as to how I can use this 13th check wisely? Perfect question, Jen. Asked will be answered in a moment.
The Money Show.
Personal Finance with Warren Ingram.
Jen is one of the privileged few who will be getting a 13th check in December, but Jen wisely does not want to mess up this 13th check. Jen wants to put this 13th check to the best possible use that she can. How can she use it wisely other than buy cases of wine delivered to Warren and Bruce's house, of course, which is a fabulously good idea, but not in her best interest. So help me out here, Warren.
Well, I think it might be in her best interest. You never know. I think... So a couple of things. Firstly, Jen, if you've got any kind of what I call bad debt, in other words, credit cards, personal loans, overdrafts, store card debt, anything like that, then that's a great place for your 13th check to go. Because, that debt, although interest rates are low now, that's really expensive debt and just really, to me, a weapon of wealth destruction. So that, I know it's boring to tell you, and it is good common sense and not exciting, but certainly the best thing that anybody could do if they get a 13th check. If you're in the fortunate position where you don't have that kind of debt, and let's say you've got a car that you're financing or a home loan, then maybe take a portion of the money and put it in there. Just be careful that the car finance people don't charge you a penalty for paying extra money into your car finance. But if they don't, then maybe put a bit extra in, and then by all means set aside some of that money to spoil yourself as well. And then if you don't have any of those debts, then I think investing that money, you said you feel that you're at an age where you can't afford to make poor decisions. I'm guessing that's all of us at any age, but definitely, make sure you've got an emergency fund. So that, that should be 3 to 6 months worth of your expenses. And if you've got that already, then invest it in a broad stock market index would be my view, maybe split equally between the South African stock market and the global market. But that should be the last step. Make sure you've done the debt, you've got the emergency fund, and then start your investment career. And to me, brilliant gift to yourself.
What a lovely idea. It really is. And it's that getting rid of the nasty debt, getting rid of the stuff that sort of gnaws at your conscience in the middle of the night, the stuff that is generating an interest rate far higher than anything else that you could afford to, anything else you could possibly earn. What is leverage, Warren, as we go into the closing stages of tonight's discussion? A phrase of the week, leverage is something that is very 2008. Is it still around?
It is around, and it's about debt. In short, the short answer is it's debt, but it's very much related to either company. So when you look at an investment company or any company listed on the stock exchange or any private company, leverage refers to how much debt they've got. And the reason why we give it a different name is because it's usually debt that you take on to buy assets that you hope will grow with value or grow in value over time. So often you might buy new machinery if you're a manufacturing business because you've got more orders and you don't have the cash to buy those machines. So you go and borrow the money and then you buy those machines and you hope that you're growing your revenue faster. And that would be leverage. Or a big property company. I don't know if they are able to borrow anymore at the moment. I think they're probably struggling. But if they wanted to expand their building and get new tenants, then they would borrow money, and that would be considered leverage. It can relate to an individual as well. So, if we borrowed money to make investments, and I shudder when people do that, but there are people that do that, then that would also be called leverage. So different from our credit cards and personal loans and stuff, which is more personal debt and usually for consumption. But leverage is borrowing money to get productive assets that you hope will grow over time. What I can say is, like any tool, you can use it to help you, or you can use it to harm yourself. So just be really careful. Make sure you know what you're doing if you're going to use leverage.
Okay. Thank you, Warren Ingram. Warren is an executive director at Galileo Capital. He is a personal financial advisor. He joins us every Thursday night.